Interest rates are at the highest they've been since 2007. From near zero in March last year, the overnight benchmark where mortgage rates are pegged in Singapore is now above 3.5%. The 3-month Singapore Interbank Offered Rate, or SIBOR, has also been on the uptrend in the past year, and it's likely to stay elevated. Singapore's mortgage rates move in line with the US Federal Reserve's benchmark rate, which are now at the 4.75% to 5% range after the latest hike in March.
Inflation is still a concern. We do expect interest rates to continue rising for the most part of 2023 and possibly start coming down perhaps as we get closer to 2024.
Until then, homeowners need to brace themselves for higher loan repayments.
$1 million loan, so for say 25 years of tenure. So in the past where interest rates were low, it's not unusual for somebody to be paying about 1.5% in interest. And this translates to about $4,000 per month. So right now, if interest rates go up to 5%, that means that his interest repayments go up to slightly above 5.8 thousand per month, or roughly around 1.8K every month. So if you total up all the interest repayments for the whole duration, this can actually add up to more than about 550,000 for the entire duration.
I think the biggest fear is how high can it go? I think people are very concerned that their cash flows are impacted. For example, they are afraid that it could result in me giving up my lifestyle, sacrificing my lifestyle to service the higher loans.
For those with existing home loans, experts say it will be best to see how they compare with existing rates and switch to a new loan package if needed. If they want to refinance or move their home loans to another bank, there are more things to consider.
What is their view of the market? If they think that the market will ease, it's good for them to take out a floating rate package, provided the floating rate package is lower than the existing package. Second, if they are self-employed, right, cash flow is important, and they want certainty, a fixed rate package will be better. So for these customers, he may move from a fixed rate to another fixed rate package.
When you embark on refinancing, a proper mortgage advisor would help you weigh the pros and cons. And usually the benefits come in the form of interest savings. And you have to pay for legal fees and valuation fees. The savings that you get must outweigh this cost involved. Most of the time, the banks would offer you some sort of a legal subsidy or a cash rebate to help you offset these costs as well.
Red Brick Mortgage Advisory says now may be a good time for homeowners with mortgages pegged to the SIBOR to relook their home loans.
Customers doing refinancing at this point of time, depending on the loan quantum as well, I would say easily they're going to save $7,000-8,000 in the year itself, depending on the loan quantum and depending on what kind of interest rates you are. And SIBOR, as we know, is going to be phased out by 2024. So if you are coming out of your lock-in period or are already out of your lock-in period and still pegged to SIBOR, I think it's best that you can start reviewing your mortgages at this point of time, because chances are you would be paying quite a high interest rate now.
There are several strategies that homeowners can also adopt to manage their mortgages. They can extend the loan tenure to reduce monthly installments, make partial payments on their loans, or take up loan features such as interest offsets.
Like a lot of customers are caught in situations where they are within lock-in and they feel very helpless about what to do. People are very concerned about their cash flows during difficult times, especially the next 1 to 2 years. Ironically, one of the strategies could be to borrow more, to take out equity on one's current property to ensure there's cash flow to go through the next 2 to 3 years. So that's part of the strategy to tide through difficult times. When times are better, one can easily do a partial payment or full repayment to bring down the loans.
Making the decision to take up a loan, pay off a mortgage, or reduce the loan amount to save on interest costs is a tough one for homeowners. But one thing to keep in mind is that interest rates move in cycles.
You don't have interest rates perpetually going up all the way. If we see a market recession, if one comes, and if interest rate comes down, would you still have made the same decision of partially repaying on the loan?
I've been in the business a long time. I've seen interest rates go from very low to very high and back down again. And generally, like any cycle in life, there will be ebbs and flows. Same thing like what you're seeing in the US, interest rates are very low, but they were very high before that. We are going to see the same cycle going through over and over again.